Hello everyone. Welcome to The Rest is Markets. Today, we're diving deep into the investment landscape of 2026, comparing the powerhouse US Fabulous 15 with Europe's resilient Super 15. Which region offers the best opportunities? What stocks should you be watching? Stay tuned, because this analysis could change how you view global investing in the coming years. If you're serious about growth and income, this video is a must-watch. 1. What is the Fabulous 15? First, let's understand what the Fabulous 15 are. This group represents the top high-growth U.S. stocks, led by the iconic Magnificent 7 plus 8 other high-performing tech and growth leaders. These stocks have driven the U.S. market's rally over the past 3 years, delivering an average annual return of around 25 to 30%. They include giants like Nvidia, Meta, Microsoft, Amazon, and others. But what makes them unique? Let's break it down. Nvidia. Buy. Nvidia continues to lead in AI and data center chips, with an 88.4% annual return over 3 years. Its innovation pipeline and market dominance make it a compelling buy. Risk. High valuation and competitive pressures in AI hardware pose risks. Regulatory scrutiny around data privacy and AI ethics could impact future growth. Meta. Buy. Meta's transition to the metaverse and advertising strength support a 42.1% annual return. Its user base and ad revenue remain solid. Risk. Regulatory risks around data privacy, increasing competition from TikTok and other social platforms, and potential slowing user growth. Microsoft, MSFT. Buy. Microsoft's cloud dominance and diversified software portfolio have resulted in a 19.5% return. Its steady revenue streams make it a safe bet. Risk. Regulatory pressures, potential antitrust actions, and reliance on enterprise cloud services could temper growth. Amazon, AMZN. Buy. Amazon's e-commerce and cloud services continue to grow, with a 21.2% return. Its Prime ecosystem is expanding globally. Risk. Margins are tight. Regulatory scrutiny over market dominance could lead to operational constraints. Alphabet. Google. Buy. Alphabet's dominance in search and digital advertising, alongside cloud expansion, supports its 14.8% growth. Risk. Regulatory challenges, antitrust investigations, and dependency on ad revenue are key concerns. Apple, AAPL. Buy. Apple's ecosystem, services, and new product launches sustain an 11.3% growth. Its brand loyalty is unmatched. Risk. Supply chain disruptions, regulatory scrutiny, and slowing hardware sales in mature markets. Tesla, TSLA. Buy. Tesla's leadership in EVs and energy solutions face high growth potential. Risk. High valuation, production bottlenecks, and increasing competition from traditional automakers. Broadcom, AVGO. Buy. Broadcom's diversified semiconductor and software business offers a 35.6% return. Risk. Supply chain issues and geopolitical tensions could impact chip manufacturing. AMD. Buy. AMD's innovation in CPUs and GPUs supports a healthy 18.2% return. Risk. Competitive pressures from Intel and Nvidia, and potential supply chain disruptions. Salesforce, CRM. Buy. Cloud CRM solutions and AI integration drive its 13.5% growth. Risk. Market saturation and integration challenges post-acquisitions. Eli Lilly, LOI. Buy. Leading in biotech with innovative drugs, Eli Lilly's 48.7% annual return is impressive. Risk. Patent expirations and regulatory hurdles. Netflix, Inflex. Buy. Continued content investments and global expansion support 12.9% growth. Risk. Competition from newer streaming platforms and content costs. ServiceNow, NOW. Buy. Digital workflow solutions have driven 24.1% returns. Risk. Market competition and slower enterprise adoption. Adobe, ADBE. Buy. Dominance in digital content creation with 8.4% growth. Risk. Subscription fatigue and competitive pressures. Applied Materials, AMAT. Buy. Semiconductor equipment growth supports 22.5%. Risk. Cyclicality of the semiconductor industry. 2. Who are Europe's Super 15? Now, let's turn our attention to Europe's answer, the Super 15, often called the GRANOLAS plus key additions. These are more defensive, dividend-paying stocks with strong global market shares, primarily in healthcare, luxury, and industrial sectors. They offer lower volatility and more consistent income streams. ASML. Buy. ASML's cutting-edge lithography machines are vital for chip manufacturing, with a 19.4% annual return and a market leader in new tech. Risk. Geopolitical tensions, export restrictions, and reliance on a few key customers. Novo Nordisk. Buy. A leader in diabetes and obesity drugs, with a 44.2% return, driven by innovative therapies. Risk. Patent expirations and pricing pressures in healthcare markets. LVMH. Buy. The luxury giant's strong brand portfolio and global presence support 8.1% growth. Risk, economic downturns affecting luxury spending and currency fluctuations. SAP. Buy, enterprise software solutions with a 22.3% return, benefiting from cloud migration trends. Risk, competition and technological disruption. L'Oreal. Buy, beauty and cosmetics leader with a 7.5% growth, benefiting from global brand loyalty. Risk, market saturation and regulatory issues in certain markets. AstraZeneca. Buy, biotech innovations and vaccines support 12.4% growth. Risk, regulatory hurdles and patent cliffs. Roche. Buy, strong biotech pipeline with 2.1% a negative return but high dividend yields. Risk, patent expirations and regulatory scrutiny. Novartis. Buy, diversified pharma with 11.5% return in a broad product pipeline. Risk, pricing pressures and patent expirations. Nestlé. Buy, global food and beverage giant with stable growth at 1.2%. Risk, commodity price fluctuations and regulatory pressures. GSK. Buy, healthcare and vaccines with 9.8% return, consistent dividend payer. Risk, patent expiration and competition. Sanofi. Buy, biotech and vaccines, 6.5% growth, steady dividend income. Risk, market growth slowdowns and regulatory risks. Hermès. Buy, high-end luxury with 18.2% growth, strong brand loyalty. Risk, economic downturns impacting luxury spend. Schneider Electric. Buy, power management solutions with 20.1% growth, resilient demand. Risk, supply chain issues and energy regulation. Air Liquide. Buy, industrial gases with 14.5% growth, essential for many industries. Risk, market cyclicality and environmental regulation. Ferrari. Buy, luxury sports cars, 24.8% growth, brand strength. Risk, economic downturns impacting luxury car sales. 3. Key comparative. Let's compare these two groups across a few key metrics for 2026. Returns. The US Fabulous 15 have delivered higher average returns, driven by aggressive growth strategies. Dividends. European stocks, especially in healthcare and luxury, offer higher yields and more consistent income. Profit margins. US tech stocks boast higher operating margins, but European giants match or surpass them in healthcare and luxury sectors. Volatility. European stocks have a median beta of 0.65, providing steadiness, whereas US stocks are more volatile with a median beta of 1.25. In essence, if you're seeking aggressive growth, US stocks are compelling. But if stability, income, and lower risk are your priorities, Europe's Super 15 provide a compelling alternative. 4. Investment opportunities and risks. Every investment has its risks and opportunities. The US stocks, while offering high growth and margins, come with increased volatility and regulatory risks. Europe's stocks, on the other hand, provide stability, higher dividends, and lower beta, but often with slower growth. Key opportunities. US tech innovation, AI, cloud, and digital transformation. European healthcare and luxury brands with steady income streams. Risks to watch. Regulatory crackdowns in the US and Europe. Geopolitical tensions affecting supply chains. Economic slowdowns impacting luxury and discretionary spending. Outro and final thoughts. So, why does this analysis matter to you in 2026? Because understanding the balance between growth, income, and risk can help you build a resilient, high-performing portfolio. Whether you prefer the aggressive innovation of the US Fabulous 15 or the steady dividends of Europe's Super 15, your investment choices should align with your goals and risk appetite. Call to action. Don't forget to vote in our poll. Which region offers the best investment opportunity in 2026? Comment below with your choice. If you found this analysis helpful, like, share, and subscribe for more market insights. Thanks for watching, and happy investing. Affiliate disclosure, The Rest is Markets, is a sister channel to Tread One Journeys. Both channels are owned and operated by the same team/creator. Legal disclaimer. Please note that the views expressed are our own. We are not financial advisors. Past performance is not indicative of future results. All strategies and investments involve the risk of loss.